Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And we just completed a survey of our investors, and we got a lot of amazing feedback with more than 100 responses. And if you're listening and you completed the survey, a big thank you. Giving us this feedback is the best way for us to keep improving, so very much appreciated. And we're still working through all the great ideas that you guys had. We'll be coming back to you shortly with, how we'll be addressing some of these ideas. But one of the main things that really jumped out to me was that you all want more insights into what's going on with defaulted loans and how we're handling them. And, one of our core values here is transparency, and we work really hard to make sure we're keeping everyone up to date with what's going on. Admittedly, we can always do better, and we'll be working on continuing to improve our communication and transparency. But another step that we wanted to take kind of in the right direction is to get you a bit of a better idea of who are some of the people running point on these loans, and at a very high level, how do we think about managing risk? So to that extent, I'm super excited to have Chris Draudt joining us on this call. Chris is our Senior Vice President of Operations. He is involved regularly with our asset management team to work with both our borrowers and our lenders when a project runs into some unforeseen challenges. So with that, let's bring in Chris. Chris, welcome.
Hi, Matt. I'm excited to be here. Thank you.
All right. So before we jump right into the discussion on how we think about asset and risk management, I think it'd be useful, if you could, Chris, to give everyone a bit of your background, kind of who you are, what you were doing before Fund That Flip, and then we can talk a little bit about some of your main duties here at Fund That Flip.
Absolutely. Thank you, Matt. Glad to be here and very excited. It really goes back to me as a child. I really enjoyed riding bikes through the neighborhood, finding homes that were under construction, and just getting in them and looking at how they were being built, the layouts, the architecture, etc. I've always had a passion and a fascination for the industry. Went to school, studied economics, came out into a Big Five consulting company to do large program global implementations. But my passion really remained in the real estate industry and construction. So almost immediately after college, I purchased my first condo in Hoboken and really couldn't afford much. So it was not pretty. So it really required a lot of work, of which I really hadn't done myself before. So really out of necessity and passion, figured out how to cobble some skills, some YouTube videos together and laid floors, restructured the layout, put kitchen counters, bathrooms in, and really just figured it out. And what I really enjoyed was the difference that the transformation that the spaces take, and it's very tangible, and you can really monitor and follow that progress so that by the time you're done, it's really just almost unrecognizable. And it's really a great feeling to add that equity and that value and really see the marked difference between before and after. I did that for about a year while working and traveling, and kind of wanted to do it again, but I didn't really have any experience in it. And so I started talking with a few friends that had relatives that were contractors, lenders, etc. And it really got to the point where I sat down with a lender and just said, how do I do more of this? But I don't want to get rid of my current unit. And from there, I learned a little bit about how to be a landlord and rent rolls and how that enabled me to purchase subsequent properties. And really, the more properties I got, the better I got at doing my own work. And then eventually, the better I got about hiring people that I could partner with or could do the work for me as I put together designs and floor plans and could kind of see that raw value in a space that others may have had a challenge to find. So I did that primarily in Hoboken, Jersey City, eventually moving into more of the Montclair, Glen Ridge area. Started
for those of sorry to cut you off. For those of you that are not in the tri-state New York area, those are all greater New York suburbs and northern New Jersey suburbs. Just FYI. Sorry.
Yes, thank you.
Keep going.
No, appreciate it.
Yeah.
So I started really with, I think my first place was 750 square feet. More recently, a lot larger homes. And what I really enjoyed about the process is every home is different. You can do different things with different types of layouts, different styles of homes, different periods of homes, and really just like the design aspect and trying to figure out how to maximize value, which really comes down to maximizing use of the property. How to best build a home for a family, for example, is different than how you might build out in design a 1 or 2 bedroom, and I find that very fascinating. And it's something that, like I said, when it's different with every home, it never gets stale. You really get to test different things out and really see how people react to them.
Yep. So you were out of school working for the big consulting firm doing larger scale kind of process improvement projects. And I think what the kids are calling it now, you house hacked your first one, right? So you lived in it, flipped it, added value, leveraged that equity you created in that one to then start doing some more. How many have you done now? And like, when was the most recent one that you completed?
The most recent one I'm kind of in the midst of right now. I'll talk about that in a minute. Let's put it at about 22 if I were to list out how many are done. My current one I'm actually living through at the moment. And it's a process. This one I think has my interest more than prior ones. I was always taught not to get too attached, that some you love, some you hate. But in the end, you've got to put the right design in place for an end user. This one I've got a lot of actual personal passion in. I just closed on one about 6 months ago. That was another very passionate one for me as well. So slowed down in recent years to focus on career and family, but I'm still trying to stay in the game. Still active, still doing it, still living it. Love it. Very cool. So I think another interesting thing for me that I think would be useful for everyone to kind of learn more about your background is you left the big 5 consulting firm and went to work for another professional services consulting firm. I believe they were around 6 or 7 or 8 people when you joined, and you were a big part in growing that firm. Talk to us a little bit more about what you were doing there and kind of what you learned about growing a growing business and putting processes and people in place to make that work well. Sure. One of the things that working in construction and real estate has taught me is I really like a blank slate. And one of the things I found attractive about going from a very large company to a very small company was the ability to really drive your own destiny. So if you've got a point or an objective you want to reach, you've got a lot more creativity and latitude to get to that end game. And that really attracted me to be able to really figure out how to grow a company, what was needed to grow the company, resource the right talent to help us achieve that, and put the right people, process, technology in place to reach our goals. And one of the things I really enjoyed about that journey over the course of the years was watching it come to fruition, making adjustments as assumptions or the industry shifted, and really the colleagues and the friends and the relationships you make along the way are something that I certainly cherish and have meant a lot to me in my career. Very cool. So you did that for a number of years, and then you joined Fund That Flip. So you're coming up on, I think, a year in March with us. Talk to us a little bit about what it is you do here. Great. What I do. So as overall lead of operations, we really have a wide breadth of responsibilities. Where I started when I joined, which I think was a very good way to get assimilated and acclimated with all the different successes and challenges in our people and process here was that I had the opportunity to work hands-on with our loan coordinators, our underwriters, our sales team, our risk managers, our accounting team, and our servicers for both borrowers and investors. So I believe I had a very unique opportunity that many people won't get when joining the business, to really peek behind the covers and do months in the life of just about all of our roles. And where that helps on an operational front to help grow and scale the company, as well as where it helps provide some value to our investors and borrowers, is I see firsthand some of the challenges we have in providing the level of service we expect of ourselves to our lenders as well as to our borrowers. And that's both in the relationship side up front as well on the back end when we're servicing those loans and ensuring those loans are progressing as expected, understanding what we look at to understand when there could be a problem, and then also how we believe the appropriate best course of action is when something unexpected comes along.
Got it. Yeah. So I think it was interesting because about this time last year, we were in the market to hire someone to help us grow and scale the business. I think we started 2018 off with, I think, around 14 people. And that was up from 7, like 6 months previously. So we're starting to figure out, like, we need someone to kind of help us think about how to grow this business, standard operating procedures, policies, procedures, getting things kind of more scalable. And there's a saying in the startup world of, like, you're looking for a purple squirrel or a unicorn. Chris's resume hit my desk, and I remember thinking, like, this is it. Like, he's got the experience in kind of process improvement with big companies. He's also helped grow a company. And to boot, he's flipped 22 houses. Like, what could be better? So I think a good fit for everyone. It seems. So one of the duties that you have here too that is really related to kind of managing our overall portfolio performance, understanding, how things are trending. One of the things that we do here from a transparency perspective is we report every month how many of our loans are, 30 to 60 days late, 60 to 90 days late, 90 plus days late, and then in foreclosure. For those of you that are listening, if you're not familiar with this, you can check out our blog and look for monthly portfolio performance posts. We post those every month, like I said, with kind of how we're doing and how our book is trending. But I thought what might be a useful kind of exercise here for this first kind of conversation on portfolio performance, Chris, is just talk everyone through, like, what does it mean to be in that 30 to 60 day bucket? What does it mean to kind of be in that 60 to 90 day bucket, the 90 plus bucket, and then really what, gets somebody into that foreclosure bucket?
Sure, absolutely. So 30 to 60 days, what we find is a few things. One is the borrower thought that they were either on ACH or may have thought that they had an escrow that hadn't yet been used in entirety. So they didn't know for better or worse, was not aware that they needed to pay. So one of the things that we assess when we look at our leads that are in that 30 to 60 day range is, was this an accident? And then can we just quickly get it rectified through a very very quick payment?
And just to kind of back up maybe a little bit, right? So we do interest holdbacks on most of our loans for our borrowers, meaning they've got somewhere typically between 3 and 6 months of interest. Kind of think of it as like prepaid. They'll come out of that period and then need to begin paying interest. We also give them until the 10th to make that payment, right? So it's possible that if they thought they were still in the interest period, the prepaid period, and then we get to the 10th, and by the time we get around to realizing they haven't made a payment and contacting them, they could be butting up on that 30-day late window, right?
Yeah.
Yep,
exactly. Another common one is as borrowers approach their maturity, they order payoffs, expect to either refinance or have a sale of the collateral, and that gets delayed. And what typically would happen is they believe that it's imminent and in very close proximity, and therefore they don't pursue an extension. And those get flagged as late as well until they do get repaid. So in either one of these scenarios, our servicing team is quickly in touch. We have reports when we measure the 30 to 60, as well as the 60 to 90, 90 plus in foreclosures. There are a bunch of key metrics, which I'll talk about in a few minutes, that we look at. But our team will reach out and assess, why is it late? What's the story behind it? If we can rectify it immediately, we do so. If not, if there's a valid story behind it, we will follow up in a predetermined amount of time, maybe a week. Otherwise, it'll hit more of a special situation bucket that we follow up more frequently if we feel like there is no resolution or exit that is imminent or in very short order.
Got it. So I think an important distinction there that I'd like to just make sure everyone caught. So you could fall in this 30 to 60 day bucket, or really any of these buckets, not only by missing a payment, but also, getting to the term of your loan, right? So the borrower gets to the maturity date and the loan hasn't been repaid or refinanced or agreed to an extension, in which case the loan will be considered within that window of 30 to 60 days, as long as that maturity date is kind of also within that 30 to 60 days. Yep.
Right.
All right. So that's the 30 to 60. What about the 60 to 90, and kind of what do we typically see fall into that bucket?
60 to 90 is some of those fall out. So those liquidity events or repayments through sale or refinance fall through. So somebody doesn't make a payment, they're supposed to refinance, it falls through. Now they have a choice that they can refinance with another lender or look for an opportunity to sell the property. That takes time. So that's a lot of times when something falls into that range, it's something was supposed to or expected to happen. It fell through, and now the borrower is scurrying for option two. In these scenarios, we work a lot with the borrower to figure out, are they willing to pay to catch up, get on time, and get an extension because circumstances have changed. At times, borrowers have completed the property. They don't have liquid assets to continue to pay. So we work with them through our relationships to try and find a way to support them through a sale or a refinance. We have relationships in the industry that will invest or buy homes, as well as those that will help to refinance these types of borrowers out. So when they're in that 60 to 90 day window, something unexpected happened. And this is a time that we leverage all the prior conversations we've had with the borrower, not just in the 30 to 60 day window, but when they were in the term of their note, to really just see if the story adds up. Because at this point, it's been a very long relationship. We've had multiple conversations with the borrowers, and we have a really good sense of what they were trying to do, how communicative they've been with us through the life of the loan, and how transparent and how accurate what they've told us has panned out to be. So when we hit 60 to 90 days, we start getting a little more diligent in asking harder questions, becoming more active in helping them find their exit, not relying on them to find it and execute on it themselves. So we become a little bit more hands-on, because here's a part that we like to manage and be very well aware of.
Yep. So 30 to 60 days, you're in that window, maybe either accidentally and we get it resolved pretty quickly, or intentionally because you think as a borrower you have a pretty clear plan to get us repaid or caught back up. Folks that we see in the 60 to 90 day window typically are there because something that they expected to happen didn't happen, right? At which point we're now starting to get a bit more involved from a show us, right? So if they said they have a property or they have a lender that's going to refinance them, show us, right, the term sheet. If they say they have someone that's going to buy it, show us a contract. And we're starting to get, as you said, right, a little bit more involved with what can we do to help to both get the bar out of the loan, but also make sure that we're protecting the interests of our lenders. Cool. So maybe let's talk about, and I think I get this question a lot. What's the difference between someone that's 90 plus days late and when we flip them into that foreclosure bucket, right? So 90 plus days late is really, the borrower found themselves in that 60 to 90 day window. We couldn't get to a resolution either through selling the property or refinancing it. Mm-hmm. So now we're at just the clock is ticking. We're at 90 days. What's going to cause us to kind of keep it in that 90 plus bucket versus move it into the foreclosure bucket?
Sure. I think the way we typically look at it, it's facts. What are the facts at hand? What's our trust factor historically in the relationship with this borrower, and what are our options? Those are really the three things we look at. So first and foremost, we can and do as necessary pursue foreclosure complaints prior to 90 days late. So that there's various things that trigger a default of the loan. In which case we then assess those three items to figure out, is this a collateral and a borrower that foreclosure is the appropriate action? Foreclosure is costly, it's timely, and it takes some things off the table, such as refinance, for example. So before we go into a foreclosure scenario, we want to understand, do we have options before we do that? Options could include a workout where we may reduce some of the penalty interest in order to get the asset refied, because one reason it's not getting refinanced is it could be due to what the new lender is willing to disperse to the borrower. When we look at trust, we need to understand the transparency and level of honesty we've seen from the borrower over the course of the loan and the during what I would call the hardship or the tougher conversations. If commitments are made and held, and the story makes sense, that there's typically more trust and various options available as to when things tend to not work and not get followed through, then there's a less of a trust in that scenario. We look at options as well. We want to understand what the different liquidity events could be that can lead to this loan ultimately getting repaid, and whether it's another investor taking the property, whether it's us as Fund That Flip taking the property, whether it's one of our relationships that might be able to do a refinance. So before we go down that foreclosure path, we're really assessing what are our options? Do we feel like we're getting cooperation and drive and the ability to execute with the borrower before we make any of those determinations?
Right. I think you made an important distinction there on the front end of that part of the talk there is we can technically file notice of default and proceed with foreclosure, the foreclosure process, much sooner than 90 days. And sometimes we will do that in order to kind of get the clock ticking on that. I think the way that we've thought about this, right, in terms of what we put in that foreclosure bucket are those loans that, the best path for us at this point is to proceed with the foreclosure, right? So it's possible there's a borrower in the 90 plus bucket. Foreclosure has been filed, notice of default has been filed, right, in order to protect our interests, but it sticks in that 90 plus bucket because there's still a higher probability that this loan will refinance or the person will sell the property prior to us getting through the full foreclosure process. Right. Like I think that's the main difference in terms of how we think about those two different buckets.
Yeah. If you were to look at that, that's correct. Anything in that foreclosure bucket means, just as you said, Matt, that the foreclosure complaint seems to be the best and most likely path forward.
Right. And that's not to say that we still won't get repaid prior to the foreclosure process and the auction and the REO and everything else. But from the knowledge that we have at that given point, based on how the borrower is responding to us and everything else. That's kind of our main path, right?
It is. I was asked today by a lender kind of what happens, and it simply can be unpredictable when we do file that foreclosure. We have investors reach out. We work with a couple of different parties, so that's correct. It doesn't mean that it's going to ultimately end there, but it means that's the path we're driving to try to solicit and really catalyze some new options that aren't at the moment available.
Got it. Cool. So if listeners are out there kind of checking out these monthly performance updates, anything else they should know kind of just from looking at the data and the different buckets that loans may fall into, or just more generally how we think about kind of high level risk management in working with borrowers to get to a liquidation event?
I think it goes back to how our teams are set up. And I said it earlier that our borrower success team, our servicing team, is in constant communication with the borrowers. So these are not people that get involved when there's an issue on the payment or the maturity and just take this file over. This is somebody we've had a relationship with for months at a time. We understand the property, the geo. And we're very careful to be strategic about supporting the borrower to exit these swiftly, because ultimately that's where the investors win. So when we look at our strategy or approach for this, it is consistently, how do we make an exit for the investors in these scenarios that is a balance of return and expediency, so that they can move on to the next one.
Preserving capital and getting to a liquidity event as quickly as possible, right? Those are kind of the two balances that we're always trying to strike as we're moving through loans, to the extent they do become troubled. Maybe the last thing that I'll have you speak about a little bit, then we'll wrap this up, is, I think we have close to 450, 500 loans out currently, and that number has grown each month. Talk to us a little bit about some of the systems that you've worked with our asset management team on putting into place for early indicators of potential problems, right? Because I think what I've learned over the years, running the company, is that the sooner we can kind of know, hey, something might be up, the more options we tend to have on getting to a resolution that works for both the borrower and our investors. So talk to us a little bit about, some of the early signals, and how we've built into our system ways to identify those potential problems before they become problems.
Yeah, absolutely. We do certainly mine our data to highlight where we believe we have risk and patterns. We will look from a payment perspective. We will count how many late payments they've had over the course of a loan. We will also look at how late they are, because we do believe there's a difference between 5 late payments that were all late by 3 days versus 3 late payments that were all late by 2 months. So we look at the data on the payments to get a pattern of the borrower's cash flow and financial responsibilities. We also look at how long it's been since their last draw and what progression and what frequency their draw is. For example, if you're on a 12-month term and you're in month 7, and you've only done 1 draw, we know there's probably a problem, unless that was a significant draw that brought you substantially through the rehab of the property. So we like to look at the draws as well as the percent complete during the draws to mine some data and draw some conclusions. Another good example is sometimes we see borrowers take frequent draws almost on every 1 to 2 week basis. In that sense, example tends to say there may be a cash flow problem, that they can't carry more of the labor and material costs.
Yep.
And lastly, we look at maturity. So one of the things we want our borrowers conversing with us on is regarding what is their exit. So if the loan is set to mature next week and we're just calling them now, that's a problem. We like to contact the borrower and have an explicit conversation regarding maturity 2 to 3 months in advance, ideally 3 months, because we want to understand, and we want to also look what is the percent complete with the rehabilitation? What has their payment history been? How frequent have their draws been? How large are those draws? Because when you look at that larger picture, and then it's 2 months to maturity, or 3 months, or 2 weeks, whatever that is, you can make a pretty good summation as to, will they be able to pursue certain paths? Will the project be complete? Is it far enough along for them to get refinance takeout? So you can draw a lot of conclusions from this data that help us mitigate and get ahead of those circumstances.
Yeah, I think this is one of the more interesting things for me that we've put into place in the last, call it 12-ish months, around mining that data around payment history, number of draws against percentage of project complete. Last time we sent an inspector out, what percentage of the project was complete, and then how much time till maturity, and what's the likelihood that they're actually going to be able to list, get a buyer and sell the property within the remaining time. Like, I think we've done a really nice job. The team has done a really nice job of looking at that data and getting that data to tell us a story, and then using that story to properly prioritize where we should be spending our time, talking to the borrowers and figuring out what's going on, or ordering additional inspections, and et cetera. So one of the things I think, if you're listening, that you don't probably completely appreciate, and it's difficult to appreciate, is the amount of data that our systems are collecting, and the way that Chris and his team are leveraging that data to be very proactive about how we're thinking about managing our portfolio and trying to get ahead of problems before they even become problems. So it's some really cool stuff, I think, from my perspective anyways.
Yeah, I love it. I think one of the best things that we look at now is we're able to, halfway through term, 3/4 of the way through term, with a borrower, sit down with them and say, look, you are not going to be finished at the end of this term.
Yep.
So what is your goal? And let's start talking about that now.
Yep.
Let's figure out, do you need help with a contractor in the area? What do you need? Because let's understand what your exit is, and let's support you there. If it's to refi, then let's refocus your work to get the home to a state another lender would be comfortable refinancing it, or that we would be comfortable extending it. So having those conversations months and months in advance has really helped us support borrowers to be successful.
Yep. Just gives us a lot more options. And I think it speaks to our commitment as a lender to, find solutions that works for everyone, right? If it works for our borrower, that generally means it's going to work for us and for our investors on the other side. Some good stuff, Chris. Appreciate you giving some insights here. For those of you that are listening and you didn't know, be sure to check out our blog every month to check out our performance reports. If you're looking for an easy way to see all of the historical performance reports, there's a section on the right side of our blog that has different tags that you can select. So the tag you'll be looking for is performance. Click on that tag and the system will filter all of the blog posts from our performance over the past several months, really since we started tracking this. Is kind of a follow-up to this initial one. We really wanted to get you introduced to Chris and some of the things that he's working on and his past experience. But we will be doing one of these once a month with Chris, where we'll take a deeper dive into that monthly performance report. We'll talk about what trends we're seeing. We'll give you guys some specific examples of different projects and some of the challenges that they're facing and what we're doing to work through those. We'll talk about some success stories of loans that we've had a successful disposition on after maybe falling into one of those buckets. So be sure to check us out. We should be posting our next performance report, which will be our December 2018 numbers in the next week or so, at which point we'll follow up quickly with another chat with Chris. So really appreciate you guys listening. If you have any feedback for us or about the show or about our platform or anything, please email us at investorrelations@fundthatflip.com. And if you want to get a hold of Chris, what's the best way for people to reach out to you directly?
Sure. You'll probably get the quickest response via email. It's chris@fundthatflip.com.
Easy enough. So Chris at fundthatflip.com or investor relations is also a good place to go because that'll get routed to, if not Chris, the best person on the team to get you an answer. So investor relations at fundthatflip.com. Otherwise, again, be sure to check out our blog for more content and be sure to tune in next week. We'll be doing a show or a call. I'm not sure what we're calling these yet, but another recording with another member of the team here at Fund That Flip and be giving you some additional insights into other parts of our business, how it works and whatnot, so you all can make more informed investment decisions. So really appreciate you joining us, Chris, and thanks to those of you that are out there listening, and look forward to having you on next time.
Loved it. Thank you.
Thanks, everybody. This is Matt signing off.